we have been talking to them. And yes, I believe we will see a nice inflow of deposits. And I think many regional banks will. I have to say, over this weekend, I think there was a crisis of confidence in the banking system in the United States when SVB failed, and then there was question as to whether the depositors would be made whole. And I applaud the federal regulators for stepping in and saying, depositors, you don't need to worry. Your money is safe. You will be repaid in totality. And then the banks that survive will be the ones that foot the bill. So I think that is a good thing, and I think you will see depositors flow towards the healthiest banks.
There are regional banks, and then there are regional banks. Your bank has been known, and you have been known, for running a relatively conservative investment portfolio, more short-term securities than long-term. You hedged your long-term securities in your holdings. You had few unrealized losses as compared with SVB, and you have a diversified client base, which they did not. Are those the keys to successful bank management in this? Is that the lesson here, basically?
It is, right? And it's not news to anyone. It turns out diversification can be a really good thing. What stands out to me as I look at what happened to Silicon Valley Bank, I cannot believe the bet they made on interest rates when rates were so low and they had this massive influx of deposits, right? From 2019 to 2022, they grew from $60 billion of deposits to $190 billion of deposits. And what did they do with that money? They couldn't make loans fast enough, so they instead invested that money. And I believe, I'm old-fashioned, I believe a bank is put here to be an intermediary. We bring in deposits, and then we should take those deposits and lend it out to good loans in the communities we serve. And they couldn't deploy those funds fast enough in loans, so they turned and they really became a hedge fund and invested that money, and in hindsight, they made some strategic mistakes.
Brent, one thing that I can't understand is if they had this huge influx of deposits and there weren't enough loans to make, and they put it in the safest stuff, they put it in treasuries and mortgage-backed securities, why are we so outraged by that? What should they have done instead?
Well, it's not that they took outrageous credit risk, right? They put it in the safest from a credit risk standpoint, but what they did is they took interest rate risk. So they put that money to work at 1.5% for the long term. And as you know, today you can get similar yielding securities at north of 5%. So now they had all of a sudden, they essentially lost $15 billion of market value on that, which wiped out their equity.
Is the problem that they weren't hedged? Is the problem that they didn't sell soon enough? I don't know. What would their other options have been at the time? In retrospect, obviously, okay, that we did a bunch of rate hikes, those securities are underwater, but what were their other options at the time?
The options at the time would be to keep that money short. Why go long with that money? They could have kept a good chunk of it short term, earning only 25 basis points.
Exactly.
They could have done some 2 years, right? They did not take credit risk from an outsider's perspective. They took interest rate risk. And so many of these failures, I'm a student of bank history, and so many of these failures go back to greed. And in essence, they were greedy. They demanded to have higher returns in the short term.
But if we go back to that period of time, you're saying the only way for them to have done this more safely, say they're in bills or whatever, they would literally have made 25 basis points. So they basically, would they even have been profitable at the time? And what should regulators have done then to say, hey, even though you look like you're in something safe, this is all going to blow up? I mean, at what point were the regulators supposed to intervene, and what should they have forced them to do? Should they have forced them to go short? Not short, but short duration, I mean.
Yeah, certainly we should look at valuing companies not just on GAAP accounting, because from my perspective, they were relying on an accounting gimmick, the difference between available for sale, which goes through your capital, and held to maturity, which is where they put the majority of their securities. So by having it in held to maturity, that didn't have to flow through their capital. Then with what happened last week, everybody was brought to their attention. Oh my goodness, look at the losses that they have on their portfolio. And they said, in essence, they have no economic value of equity.
Brent, I want to close with one question, and I know that your bank does a fair amount of commercial lending to commercial borrowers. I want you to listen to something Josh Brown said about an hour ago on Scott Wapner's program. Let's listen to his views on commercial real estate, and then I want to get yours.
Commercial real estate is the next shoe to drop, specifically office building real estate. There is so much trouble coming to this sector, both in the forms of headlines, in the forms of large private investors walking away from buildings, in the form of leases being re-signed at much lower prices per square foot in cities like New York, Chicago, even Miami.
Several of the banks that have been on the troubled list, including First Republic, were exposed in commercial real estate, office buildings. What about you, and how do you react to what Josh Brown just said about vulnerabilities in commercial real estate?
Yeah, first, I don't think Josh is too far off base, but I think you have to look below the surface because there are different kinds of commercial real estate. Commercial real estate can be an apartment loan, and it can be an office building, and it can also be a speculative ski resort. So you have to look behind the headlines of commercial real estate and say what kind. The vast majority of our commercial real estate is shelter-based. People need a place to live. I do think there will be weakness in terms of office, but the weakness will be concentrated on the large metropolitan areas. We're still seeing all kinds of strength in office in the markets where people are coming into.